Hey everyone, and welcome to this explainer. Today, we're going to take standard, dense technical analysis and transform it into a highly actionable visual toolkit. We're diving deep into our source material to figure out exactly how to read the hidden, underlying rhythm of the market. Let's just jump right in.
Okay, so here's our roadmap for today. We'll be hitting 6 main areas: decoding the market's rhythm, rules of the waves, the cyclical nature of price, location is everything, mapping market psychology, and finally, mastering price channels. Section 1. Decoding the market's rhythm, finding the 5-3 pulse.
So when you first pull up a volatility chart, you might think, wow, this is just pure chaos, right? But I promise you, it's really not. Beneath all that apparent randomness, there's actually a totally predictable pulse, and it's driven entirely by collective human behavior.
And that brings us right to Elliott Wave theory. This is an absolutely incredible framework from our sources that takes all that complex, messy investor psychology and translates it into recognizable patterns. It basically gives us a tangible language to interpret what the market is actually trying to tell us.
Now, the absolutely crucial thing to grasp here is that this language has 2 distinct phases. First, you got your motive waves. That's an aggressive 5-wave sequence that actively pushes the trend forward. And then you have corrective waves. That's a 3-wave sequence that pulls it back, giving the market a natural pause, a breather, before the main trend kicks back in.
And this brilliantly illustrates that classic 5-3 rhythmic pattern in action. Over in the blue section, you can see those impulsive motive waves, waves 1, 3, and 5, aggressively pushing the price up. Meanwhile, waves 2 and 4 step in to provide those minor corrections. Then, moving over to the red section, you get that larger corrective phase pulling against the entire progressive move. It's literally like a giant tug of war.
But honestly, what's really fascinating here is the fractal nature of these movements. Just notice how that overarching 5-3 structure repeats itself at every single smaller scale. Seriously, whether you're zooming way in on a 15-minute window or zooming out to look at a massive megatrend, this exact same structural blueprint applies. It's waves all the way down.
All right, moving on to part 2, rules of the waves, the unbreakable math behind the movement. Now, we can't just draw lines wherever we want. This analysis builds on strict mathematical rules to keep us grounded in reality. The source emphasizes a few totally unbreakable markers. For instance, wave 2 can never ever fully erase the progress of wave 1. That's rule number 1. Also, wave 3 is usually your most dynamic, profitable move, and it's never the shortest wave. Oh, and wave 4? It generally cannot cross back into wave 1's territory. Keeping these strict boundaries in mind prevents us from making wildly incorrect assumptions.
Furthermore, these wave structures are tightly bound by Fibonacci mathematics. Take this 61.8% mark, for example. That is a highly common, super reliable retracement target for wave 2. Honestly, it is almost eerie how the market naturally gravitates toward these specific mathematical ratios time and time again.
And looking directly at this chart, you can see exactly how these Fibonacci ratios provide us with concrete guidelines. Notice how wave 2 corrects right to that 61.8% level of wave 1? And then boom, wave 3 rockets up to 161.8%. Using these ratios isn't just theory. It allows analysts to actually predict wave breaks and manage risk effectively.
Okay, section 3, the cyclical nature of price, timing the market's breath.
So now that we know the shape of the move, our source shifts focus to the timing. And listen, this is a major trap a lot of folks fall into. You cannot call these time cycles. Why? Because time only flows forward, right? Thermodynamics guarantees that. Instead, we need to realize that it's the price that cycles dynamically through time, creating these regular, measurable peaks and valleys.
Just notice the incredible consistency of the wavelength in these regular peaks and troughs here. Once you understand this rhythmic cycle, it's a total game changer. It allows us to anticipate exactly where and when the price might reverse next. You're no longer just reacting to the past, you are actually projecting into the future.
Which brings us to section 4. Location is everything. Context dictates direction.
This leads to a massive paradigm shift in how we read charts. According to the source material, a candlestick pattern means absolutely nothing, literally zero, without knowing its location within the cycle. For instance, notice this bearish shooting star formation right at the top here? It is incredibly reliable because it appears perfectly at a projected cycle top right when the market's upward energy is totally exhausted. But if that exact same candle appeared right in the middle of a cycle, it would likely be completely misleading.
And this perfectly demonstrates the danger of ignoring context. Look at this. We have the exact same symmetrical triangle pattern sitting in two totally different spots. In the middle of the cycle, it acts as a bullish continuation, a green right. Yet, when that exact same shape forms at the peak, it becomes a bearish reversal. The pattern's name didn't change at all, but its location, that completely flipped its meaning. Location is truly everything.
Card 5. Mapping Market Psychology. Drawing the Boundaries.
So, armed with all this knowledge of waves and cycles, how do we actually trap this energy? Well, analysts use trend lines as a tangible visual projection of market psychology. But keep in mind, not every line you draw is valid. A truly reliable trend line usually sits at a nice 35 to 45 degree angle. Anything steeper than that just burns out way too fast. And most importantly, it demands multiple clean retests. Every single time the price touches that line and respects it, more and more traders take notice, which just exponentially grows its psychological power.
Finally, Section 6, Mastering Price Channels, the ultimate roadmap.
For our final structural step, the source shows us how to take these single psychological lines and turn them into actionable corridors of movement. Drawing a perfect rising channel is actually super simple, but so incredibly powerful. You just connect two key swing lows to establish your base support. Then you find the prominent swing high right between them, and you draw a parallel line straight up. Just like that, you've built yourself a roadmap.
And seeing this mapped out really brings the whole shebang together perfectly. Inside this channel, the lower boundary acts as a high-confidence entry zone. When the price hits that bottom line at the exact same time it hits a cycle bottom, wow, that creates massive bullish confluence. You are literally aligning both the trend's shape and the cycle's timing all at once.
As we wrap up this explainer, I really want you to consider this profound quote from our source text. The market is a forest, and every tree is a forest within itself. It perfectly sums up the nested, fractal nature of these market patterns. The massive overarching trends are made of smaller channels, which are made of even smaller waves. It is all beautifully connected. Trend lines draw the shape, cycles give you the timing, and waves show you the underlying psychology. So I'll leave you with this. Are you finally ready to use this combined visual toolkit to stop guessing and start moving in perfect sync with the market's hidden rhythm? Thanks so much for joining me on this explainer, and I'll catch you on the next one.